First of all, there are two types of inflation. There's the supply-demand inflation, when demand is strong enough and it presses up against capacity, like you don't have enough labor, unemployment rates are low, and capacity is low, and then prices go up, and there's that kind of inflation. And then there's a monetary inflation, which comes from the supply of debt being too much so that they produce more of the money, and the holders of those financial assets, particularly bonds, because bonds is just a promise to receive money that the central bank can print. The holders of that then go into those other things. And then what happens is then you just have to follow the money. So you see who gets the money. And then when they get the money, you see what they do with that money. So let's say if you change who gets the money now, because we're going to change that, taxes will change that, other things will change that. That goes then to those other people. So the inflation, the big inflations, the ones that are really most important are not the ones of the supply and the demand. They are the ones like that which followed 1971, my example. Okay, there's not enough money. You put it down, you devalue, in other words, you sever the link. And then with that, then there's a monetary inflation. You go into those other things, and then you have that. So let's say there's two risks. We will have a hell of a lot of demand because we put all that money in. Cash is all over the place. And even investments, all the investments go up because of so much cash. And how do you find a good investment? But also there's so much money, and it'll change the amount that is in the hands of individuals and so on. And so now it's in cash, and that'll move on because cash is trash. I'd say that because it'll have that negative real return. So we're going to the real risk. You'll experience more inflation. Right now, a lot of it is in cash, and there'll be a lot more money being produced. But you'll experience that more in that kind of inflation. Things will go up. You could see inflation in houses, inflation in, many things is going up. And then you'll start to see probably some labor inflation. If you start to see labor inflation and so on, it'll be a different kind of inflation though. It'll be because we're in a more digital society, there won't be, those things can be produced. That supply of digitalization can be produced without the capacity constraint. But the big monetary inflation is the thing. Where do I store my wealth? Because what happens to the market is then when you go to those other things, let's say you go to stocks, you go to real estate, you go to other things because they're getting out of that. As those prices rise, like a bond, their future expected returns go down. And as they come closer to the interest rate, so now you've got whatever the interest rates are, it depends on the country, but it comes down, then there's no longer the incentive to buy those things, and you could have trouble. And it becomes very difficult to tighten monetary policy because the whole thing falls apart. Everything's interest rate sensitive. And so the central bank has got to then print that. Then you have negative real returns in stocks and other assets, like we did in the 70s, but the nominal return goes up. That pattern has happened over and over. And I'm just trying to describe the mechanics of it.
Right. So maybe let's look at this from the geopolitical perspective. You talked about the importance of there being a challenger to the hegemon, and we've got China out there. I want to just sort of frame this though in the moment a little more than a year ago, when the world really went into the first sort of financial aspect of the COVID shock. And at that moment, it was clear that there was a desperate shortage of dollars. You've talked about this rise up of debt around the world, and much of that debt is dollarized. And so in particular in Europe, we had this huge demand for dollars. And the Feds did what it's done before, but in this time it did it on a much larger scale. And that is that it printed a lot of money at home, but also opened those swap rates and flooded Europe with dollars as well. And it was interesting because the illusion I felt at that time that I was hearing from a lot of folks was like, oh my God, look how strong the dollar is. The dollar has never been stronger because everybody wants it. But it struck me that there was something falling apart here, that the actual dependence on the dollar was a political problem now, that there was this, we are locked into the US monetary policy cycle in a way that we never have before. And that is really anti-democratic. And so it seemed to me that the cracks are there right now when it can look as if it's too strong. At the same time, as you rightly point out, China is rising. And I'll get to what I think is the other piece of this, the technological part of it, the rise of Bitcoin and the rise of central bank digital currencies in a moment. But lay out for me what all this means on that global stage, the geopolitical piece of this, and China as well.
Well, it's a great power to be able to print the world's currency, but it just happens like the British pound happened, and it happens like the Dutch guilder happened. And as you point out, if you have a debt in a currency that you don't print, you have a short position. And so that's what, money and credit is not a fixed supply. It just kind of contracts. You get a debt contraction. And so if you look at what happened in April 8th and 9th, where the central government and the central bank got together and did that happened very quick. And so you hardly noticed the short squeeze. If you go to the time before that, so that took barely days, maybe a couple of weeks. If you go to 2008, that took nearly a year, but it was the same thing. And if you go to 71, it was the devaluation. And if you go to March 5th, 1933, it was the same thing, but that took place, there was 1929, and it took until 33, and you have a depression. So if you don't do this, you have a depression. That's why the depression lasted, 1920, it was 30 and through 33, the beginning of 33, you have the depression. And then 2008 was much shorter. And this one was a nanosecond and much bigger. And so it creates that short squeeze. There is a supply demand for these bonds now. So it's important to understand that. So now the world, because the dollar is a world's reserve currency, the world is long a lot of dollars or dollar-denominated assets or dollar-denominated debt, let's say. It's about $23 trillion of dollar-denominated debt that they're holding. The holders of that are holding, like they can convert that and so on. And there's a supply-demand problem, because if you have a deficit, that means you have to sell bonds. And so that means that the holdings of those bondholders have got to increase. They're overweighted in debt, in dollar-denominated debt. It doesn't pay much. I mean, it's negative real returns. And you've got to buy a whole lot more of those bonds. And they don't want to buy a whole lot more of those bonds for various reasons. And then you also have China as a more effective competitor for capital, because what's happening is it's a competitor, and it's not just a competitor, let's say military, it's a capital markets competitor, the companies it's producing and so on. In 2015, only 2% of Chinese markets were open for foreigners. Now it's over 60%. And if you look at the relative pricing and so on, it's a whole different story, because they're not doing quantitative easing. They're not doing whatever it is. They still have an attractive bond market. They have attractive capital markets that are more open. And as they're more open, and big investors, institutional investors, central banks and so on, view themselves as underweighted there. Even if you want balance, you're getting the supply demand for these US bonds coming, and you want to move that. That creates a supply demand problem that then can only be manifest in resolution by either the US raising interest rates to attract that, or the dollar devaluing. Okay, so now we're dealing with that dynamic. So this is very similar when we went from late 60s to 1970, we had a recession. And then there was a difference between what was then the Deutsche Mark and the yen and how much they were printing and how much the United States was printing. And that was the problem. So you have a difference in monetary policy, supply demand, that is working on that. So when you bring up China, it's not just a geopolitical and not just a technology or, it's a capital competitiveness thing. That means that when you buy a Chinese financial asset, like buying an American financial asset, you have to buy their currency. So it's supportive to their currency, and it's also supportive to their assets. And then in addition, part of this cycle has always been that if you're trading, if you're a large percentage of world trade, China now is the highest percentage of world trade, then there's the capacity to bill in your currency or lend in your currency. China has been very reticent to do that, not to disrupt the system and so on, but you're seeing more the internationalization of the renminbi. So it has appeal for borrowers and lenders and so on. And so that dynamic is really following the same arc of monetary systems and empires pattern.